Hello and welcome to this week's episode for SPY Trader Now, where we try to beat the returns of the SPY S&P 500 buy and hold investor. That's our goal here at SPY Trader Now. This week, or our year-to-date returns as of January 28th, 2023, the SPY Trader Now portfolio is up 1.13% year-to-date, whereas the SPY buy and hold investor is up 6.08%. So we have some making up to do, as the SPY buy and hold investor is doing very well year to date. This is right at the end of January, so it's about a 1 month return there. And currently, what we do here is we do a 3-position portfolio at SPY Trader Now. We either have shares of the S&P 500 and we buy the electronically traded fund symbol SPY. That's why the handle is SPY Trader Now. We either have the shares of stock directly, or we'll do options, and we do both calls and puts, and we buy and sell options, or we have cash. Currently, we are 100% in cash on our portfolio, as you can see right here. We start the year off with a starting capital of $100,000, and we build from there. At SPY Trader Now, we are not buy and hold investors, but we buy, sell, and trade the S&P 500. And we try to put more of this green in your wallet. Now, here is a chart of the 1-year chart of the S&P 500, and we're going to go through the charts in much greater detail later on in the presentation. Here are some past returns for SPY Trader Now, just to show you how well this strategy does. In 2022, the strategy returned 21.18%, whereas the SPY buy and hold investor was actually down 19.48%. In 2021, this strategy produced a gain of 78%, and the S&P buy and hold investor only returned 28%, and in 2020, the SPY buy and hold investor received 15%, and this strategy returned 100% in year 2020. It was a fantastic year in 2020. So if you want to see how this is done and follow along, you can go ahead and subscribe, hit that subscribe button, ring that bell to be notified when I post a new video, and do me a solid and smash that like button down for me right now. Thank you. Now, for the past week, the S&P 500, this is a weekly chart, gained 2.48%. So it was a very good week. And the S&P 500 did something else during the week. You see this long-term resistance line I have drawn in here? We closed above it, but we are currently at the 410 resistance line right now. You see right here in the thumbnail, this candle? That candle is last week's action on the S&P 500, and we are right at this top level here. There's a lot of risk that we are just going to not breach that right now and come back down, and we'll show you that during the presentation. There were no trades in the past week ending on January 28th, 2023. Now, here are the trades that I have made so far this year. The last trade was made on January 19th, which was a cash secured put trade. That trade expired on January 27th, 2023. So that was on Friday, just yesterday actually. So we've made some money. We're doing okay. You can see the money that we made here on our positions that we had, and this is where we're currently at for our portfolio. I'll leave a link down below, but my website is spytradernow.com, and this is where you can see a full list of all my trades going back 3 years. And if you would like to sign up for real-time trade alerts, you can go to this website. Now, here is the portfolio year-to-date for SPY Trader Now. Now, last week, you see we were flat because our trade was made previous to Monday of last week. So this goes week to week on this particular chart. So it tells you where we're at. So this is our equity curve for SPY Trader Now. This is the SPY buy and hold investors equity curve for 2023. You can see they had a fantastic week as a buy and hold investor. Now here are the two strategies combined in a percentage basis. So we are always doing a comparison analysis benchmark. So we are trying to determine how well is the SPY Trader Now portfolio doing in comparison to the SPY buy and hold investor, using that as our benchmark. So the pink line here, that's the SPY buy and hold investor. You can see they're right about 6%, whereas ours is just over 1%. We have 5% to make up. We have a lot of ground to cover here to make up, but we need to look at what our comparison benchmark is to determine how well this is doing. Obviously, if we have a strategy that is not beating the S&P 500 buy and hold investor, that is not going to be a sound strategy to keep for the long term. I feel very confident over the next 12 months we will absolutely beat this S&P 500 return, but right now the S&P 500 is beating us. Here is the Fed Chair Jerome Powell. The last interest rate hikes were done on December 15th of 2022, where they raised 50 basis points, bringing the short-term Fed rate level to 4.25 to 4.5%. Forbes predicts that in 2023, the terminal rate will be somewhere between 5 and 5.5%. So obviously we have more room to add, increase interest rates. Here is the FOMC meetings for 2023. The next meeting is this coming week, January 31, and they're going to make the announcement on February 1st. There's a 96+% probability that we'll have a 25 basis point rate hike on February 1st. That is already baked into the cake, meaning that the market is already priced for that interest rate hike. What will be more important is the announcement that the Fed will announce that they're going to raise the rates 25 basis points. They'll also have some other words in their statement, and depending upon what how those words are, what I mean by that is, are they dovish or hawkish, will determine how the market reacts to that statement. We need to wait and see how that's all going to play out, and that's all going to happen this coming week. Now, here is a very bearish stance from the bond market's outlook. The bond market currently has an inverted yield curve. What that means is the long-term interest rates, this is today's date, January 28th, 2023. The 10-year yield is currently yielding less than the short-term 91-day yield and the 2-year yield. So that means it's upside down, or an inverted yield curve. An inverted yield curve is a precursor towards an economic recession, two quarters back to back where we have downward growth. So we'll have negative growth, and that will be considered a recession. This is completely forecasted to happen, at least from the bond market's perspective, in this year, calendar year 2023. We're only into January, just getting ready to start February. So we've got 11 more months of this year to go, and it's going to be a turbulent year, 2023. The bond market is predicting that it's going to be a very turbulent year. This is not normal to have an inverted yield curve. So something is going to happen, and it's going to happen within the next 11 months, most likely. Another thing that's negative from the bond market outlook is our rising interest rates. As far as equities go, or stocks do not do as well when you have a rising interest rate market compared to a falling interest rate environment. So right now, you can see that 1 year ago, the 10-year was at 1.78%. The 10-year today is at 3.46%. That's rising. This is a larger number than this number. It's a rising interest rate. So these are not good for equities in general. In general, this is telling you should really be in cash until this equity curve gets corrected and the 10-year yield gets higher than the short-term 3-month and 2-year yields. Now, this information was derived from bankrate.com. There'll be a link down below, so if you want to check out this information and verify it on your own, you can. But here's a snapshot, and this was updated on at Bankrate's website on January 25th. So we're just a couple days old on this data, so it's pretty fresh data. Now we're going to look at things from a seasonality standpoint. We're going to use the S&P 500 going back 20 years of data. Each one of these bars represents a month. This is the month of January, and that the number comes up as 50. That's telling you that 50% of the time in which the S&P 500 closed higher than when it opened, going back 20 years. Currently, now this is a monthly chart. Each one of these bars represents 1 month. The chart is going back 1 year. So for the month of January 2023, our current year, the current month is up 6.08%. And on a seasonality stance, this is telling you that we had a 50-50 chance of being positive in the month of January. So from this standpoint, we're overextended, to the upside. There's 6% downward risk here before we have a neutral stance according to the 50-50 seasonality stance. Okay, so from a seasonality standpoint, we're in neutral, but because we've gained 6%, we're actually overextended because that's where we stand right now. Now, one thing that the market did that was bullish is that you can see this downward resistance line drawn at the wicks of the candles, and we have broken and closed above this downward trending resistance line for the first time in a long time. Going back 12 months here. So this is possibly the beginning of a new bull market, and we're going to be keeping an eye out for that. But from a seasonality standpoint, for all this, for what's happening, for this data that we're looking at on this page, this is telling you that we're a little bit overextended right now from a seasonality standpoint. Here is a 20-year chart for the S&P 500 monthly chart, and over here on the right, I drew in the support lines and resistance lines, and we are right now at that upper resistance line. You can see that we just slightly broke above it right there on the thumbnail, but we haven't closed above this peak here from the previous month. We got to clear that to show that we're making higher lows and higher highs. Until this high gets taken out, this high is not a higher high. An upward trending market is a market that makes higher highs, higher lows, and this is what we need to do. We've made the higher low right there. That's a low, that's a higher low, that's a high, but this is not a higher high. We are waiting for that to happen. So we need to see that happen. But these are all steps to take that we'll see in progression to know that we are now entering into a new bull phase, and we're out of this corrective phase right here. But we haven't totally cleared it yet. Now here is an intermediate term outlook. And so we use the weekly chart, S&P 500, always looking at the same information here, but now we're looking at each one of these candlesticks represents 1 week's worth of data, whereas the last chart, it was 1 month's worth of data. Here you can see the downward support and resistance line, and we've closed above this downward resistance line, but now we are at the 410, which is the resistance line from these previous highs that we made a short time ago. We need to clear that and see if we can make that higher high like I just talked about. Now, one thing that's really bullish on this page here, and I pointed this out last week, is how the MACD was starting to come down towards its signal line, did not reach the signal line, turned positive, went north, and began to create more distance between the MACD and the signal line. This is a very bullish stance for the MACD, which is a bullish stance for the chart that it's looking at, which is the S&P 500. Now here we are looking at a daily chart, S&P 500, going back 1 year's worth of data. And you can see that on the 1 year chart, again, how we've crossed above this resistance line, and we are at the 410 resistance line here. And on the last candle, which is this candle right here in the thumbnail, you can see that we came up just about tagged the 410. We didn't quite tag it, just about tagged it, and then dropped off and it closed halfway. So it's possible that we have reached a ceiling on our current trading. And by the way, it's been very bullish for the past few weeks here on the S&P 500. So having a pullback would not be out of character for the market. So we're expecting some type of a pullback. As they say, trees don't grow to the sky. So we're expecting some type of the ceiling to be reached here, and we may have reached it right now as of on Friday, but we shall see. You can see here also the trade that I made, and when I made it on 119, the cash secured put trade, that was on this candle right here, and then the market just went up good. So I took a very conservative approach at this point in time for the fear that maybe the market was going to continue to come down, but the market put the brakes on and came up. So that's what happened during last week's action. Here is the VIX, or the volatility index, or the fear index. And the VIX right now is in this downward wedge pattern. And I drew in two different support lines here. One at the body of the candles and one at the tails of the candles. That's these two lines here. We've already reached the body of the candles support line right here. We tagged it and bounced up off of it. Now, the VIX works inversely to the S&P 500. In other words, when the VIX is going up like this, the S&P 500 is going down. And when the VIX is going down, the S&P 500 is going up. So it's an inverse relationship. Right now, we are at the bottom end of the VIX. We just tagged the support line, bounced off of it, and it's possible that it is now going to come up, which is bad for stocks. And if we break this line here, which is a longer term resistance line, that means that the VIX is now going up and starting to go north and going up like that. Well, that's going to be bad for equities. That's why I drew this one in red and this one in green. Also, I put down here, this is when you want to sell the S&P 500, and up here, when we tag this line, that's when you want to buy the S&P 500, because when you buy the S&P 500 here and the VIX is coming down like that, you are making some serious cake when you're in that type of a position. Now, there's one other thing to call out on this chart, and that is the MACD divergence. Let me explain. So the MACD made a low here, and you can see where it's currently at. And I drew in a trend line here. This line here is sloping positive, whereas from this line here to this line here is sloping negative on the actual VIX. Well, that's a positive divergence for the VIX, which, because it's inverse, is negative for stocks, meaning that the MACD is more bullish than the actual VIX. And the actual VIX, if it's going to match the MACD, is going to turn around and start going this way, and that's going to be bad for stocks or the S&P 500. We are looking at a one-year chart of the S&P 500 on the Think or Swim platform, which is my broker TD Ameritrade. And here you have pink lines and you have gold lines. The pink lines are the minus and plus 1 standard deviations, and the gold lines are the -2 and +2 standard deviations. 96% of all trading, or 95% of all trading, takes place between the +2 and -2, and 65 or 67% takes place between the -1 and +1. We have just broken above the +1. We're almost at the midpoint between the +1 and the +2. Last time that the S&P 500 breached the +1 and was about halfway between the +1 and +2 standard deviation lines, you can see what happened here. Last time here, where we just barely breached the +1 standard deviation, correction came down. +1 standard deviation, correction came down to the midpoint, not to the -1 or near the -2, only to the midpoint. That's bullish. But now our upside is limited. Now I'm going to show you this on the 3-month chart in the next slide. It's more granular. So here you can see on the 3-month chart, where we are currently at between the +1 and +2 standard deviations. We're about in the middle, and we came up and we got a wick going on here, like we hit a ceiling and we came back down. Now, last couple of times on this 3-month chart, we actually did tag the +2 standard deviation before we started to show correction. We don't have that correction shown in yet because it hasn't happened yet. But the point of this chart is to show you that you have limited upside before you're going to hit some type of a ceiling on a probabilities basis. So nothing's guaranteed in stone, folks. This is just probabilities that I'm speaking about. There's a higher probability that we're going to hit a ceiling, if not already, very soon, limited upside potential, before we start heading down. That's the point of this particular slide, is to show you that we have limited risk. So yes, the SPY Trader Now portfolio is less than the SPY Buy and Hold Investor by 5%. Does that mean I just want to go all in on and buy SPY right now? No, it does not. I don't want to do that, because that now would not be a prudent time to go to an all-in position, because we're getting ready to hit some type of a ceiling here soon. So here is my market summation for SPY Trader Now as of January 28th, 2023. The market is at the top end of a trading range, and it must clear the 410 to be blue skies ahead. That has not happened yet. When that happens, as I showed you earlier in the presentation, we're going to have higher lows and higher highs. We have the higher lows, but we don't have the higher highs yet. That's the definition of an uptrending market. We don't have that yet. So what am I going to do? I'm going to watch the market for now on the sidelines in cash, and I'm going to see what happens. I want to see what happens after the Fed meeting on February 1st, 2023. I want to see how the market reacts to the Fed's statement. I want to see how that plays out. That will help me to determine how I want to play the market going forward. But for right now, considering where we are at, close to the +2 standard deviation on this 3-month chart here, I don't see much gain going long in this market right now. So if anything, this market's going to go neutral, or more likely have some type of a pullback. We've had a pretty good run here. We've had an excellent run. We captured some of these gains, but certainly not the gains of the buy and hold investor. The buy and hold investor has outperformed our portfolio. I completely recognize that, and let's give credit where credit is due, and it is due to the SPY Buy and Hold Investor. It has done very well over the last week. That is going to conclude this week's episode for SPY Trader Now. I am your host. My name is Ken. I hope you have enjoyed this week's episode. If you have not done so already, please go ahead and hit that subscribe button, ring that bell to be notified when I post a new video, and do me a solid and smash that like button down right now. I wish you good trading.